Let's bring Jenny back in. Talk some FOMO here. We got a fun one. Not so fun price performance as of late over the last few years, but we're watching an area of the market, the social media world, that was already sort of this rogue, almost wild west in terms of regulation and uncertainty and invasiveness and privacy and advertising, and in many ways, in the case of Meta, cash cow. And this thing was printing money. And then it just decides out of nowhere that it's just going to change its name. It's going to put all this money and investment into something that seems so far in the future, and it didn't work yet. Yet's the right word, I think, but it's not working yet. And for the first time, I think, since its IPO, the former Facebook, now Meta, is seriously under pressure.
Yes, and I think that's a really good point, because I think they hoped that the metaverse rebrand would then move them away from some of these antitrust and sort of privacy headwinds. But the fact of the matter is that they haven't actually done enough to then shape up their brand perception. There is still that thought that they are invading our privacy as users, and they are using our data to then sell to their advertisers, which is really truly how they are a cash cow. So metaverse aside, this is still, to me, the Facebook problem that we're seeing. In terms of this headline we got today, actually, this top European Union privacy regulator ruled that Meta can't use its contracts with Facebook as well as Instagram users to justify sending them ads based on their online activity, which is exactly what you see if you're on either Facebook or Instagram. The targeted ads have only increased, I think, in their usage and their targetability, really, in the last few years. This would be a major blow to digital ad industry. Meta said they disagree with the ruling. They do plan to appeal it. This was officially announced Wednesday by Ireland's Data Protection Commission. The agency imposed fines of about 390 million euro, or about 411 million US dollar on Meta, alleging it violated EU privacy laws by saying such ads are necessary to execute its contract with its users. Now, litigation, important to keep in mind here, could take years, but if the decisions are upheld, this could mean Meta would have to allow its users to opt out of ads that are based on how each user operates with its own apps, something that could really affect its core business. And I have to say that the more and more you read about some of its privacy habits, the more as a user you think, well, why shouldn't this be allowed? Why do I not have the freedom to say I don't want them to tap into my online activity? I think that seems very fair, and just the more we learn about online habits. Now, additionally, News Street today did start coverage on Meta platforms with a buy rating and a $145 price target. So the news was not all bad hitting Meta today. The analyst said the basic FANG trade may be dead, but he believes many U.S. internet stocks still offer attractive valuation entry points, given the fact that Meta fell sizably in 2022. I mean, this is an ugly daily chart. We just see massive gaps down, those of course related to their earnings. But I think they've got to do some brand restructuring. The public perception on at least Facebook particularly is not too positive right now.
Yeah, this is a difficult thing to unpack. That's so complex. It's so much in the early stages of ultimately wherever this may go. But I think you look at the actions taken by Meta platforms, that not necessarily in the sense of restructuring and changing brand perception, although that could be important, more about diversification of revenue streams. If we look at how Facebook has operated, it's in a space where it's been fairly fickle. I mean, Facebook took out MySpace, which is not really a thing. Instagram became the big thing. Now there's TikTok and Twitter and all the different ones, Snapchat, and they all get varying degrees of activity. And you start looking at that is Facebook is looking for, or Meta now is looking for ways to create revenue from something completely unrelated. Because one, they can't know for sure that they're going to be the most popular app, but they also can't know for sure that the business model that they're operating in will still actually be something they can do in the future. So I appreciate the efforts to diversify and invest into other things. Just the metaverse just is the funniest thing that seemed to be the one that you're going to hitch the wagon to. That being said, though, Jenny, one of the things that I think no one really talks about is sort of the last thing I'll say about this before we talk about the trade is there's it's no secret. There are real people on these apps, and there's not so real people on these apps. But if I'm Facebook or Instagram or any of these social media firms, and I'm going to a company and I'm negotiating with you, and I'm saying you're going to see this many, this is your reach. Mm-hmm. You put an ad on here for this much money. This is how many accounts are going to see it. Well, I need to know how many of those accounts are real customers I'm going to have, because if it's a big chunk or bots or even a small chunk, it's still not the same And so when you see these daily active user numbers and all this stuff, how much of that is real people? 2 point some billion? Are we really thinking that those are all real people?
I know, and it also, as a user, makes the app, when you see all these bots and like fake people commenting on stuff, it does make you mistrust the app a little bit. And I guess that's Elon Musk's whole issue right now with Twitter, is there's too many bots on these apps. And we've for so long given the excuse that social media is new, it's still a novel concept. But I mean, wait a second, I've had Facebook for like 15 years at this point. So when are we going to stop making that the excuse? I don't know. But trading Meta, this name is controversial. It does have its risks given its antitrust overhang here. But this is a name that, say, perhaps in terms of social media usage, people are still on Facebook, they are still on WhatsApp, they are still on Instagram.
Yeah, and those core businesses, they're declining, but they're still extremely successful. Yeah, they put a bunch of money into this new technology and this new business venture. We don't know how that's going to shape up, but we're also looking at a company now that's 30% of the value that it once was at its peak. That's a substantial sell-off. So even amidst all of this uncertainty, you look at this and say, hey, you know, a year and a half ago, I was willing to spend over 3 times more than I am now to be an investor in this company. And many of these analysts were very optimistic about Meta at that point. And so kind of a price standpoint sometimes too, and acknowledge the risks that are out there. And that's not to say that it's going to go higher or going to go lower. It's just more of, if you have a positive outlook, you understand the risks, and you're comfortable taking those risks to look for some type of recovery. You know, you can never really have a perfect time. There's always risks associated with it. But this analyst at New Street talks about it, talks about the buy rating, talks about a 145 price target, and that's ultimately what I used to structure this trade. So if you're looking for something that's going to move towards 145 over time, this is a strategy that could benefit if that happens. We're looking at buying a call condor, so it's a 4-legged trade. But it differs from what we looked at in Target, for example, Jenny, because if you looked at the trade in Target, it had 2 calls, 2 puts. This is all calls. And so we're buying a debit spread. In this case, that debit spread is $10 wide, and then we're selling a credit spread above it to reduce that overall debit. And so the exact strikes here are going out to the February monthly cycle, the 17th, buying one of the 125s, selling one of the 135s, and then going up a little bit, selling the 145, buying the 150 to define the risk. Total debit on this is 350. That means the break even would be theoretically 128.50, which is pretty close to where we're trading now, which is sort of a theme in these strategies that we look at that are done for a debit in which we're buying premiums, trying to get that break even near where the current trading price is. But then also you'll notice that the profitability graph then levels off and goes lower around that 145 mark. So that corresponds to the analyst price target to the upside. So best case scenario would be between 135 and 145, in which this one can expand out to $650 on $350 in risk if it does sell off below 125. If it does go all the way through 150, because that 350 debit is less than the $10 minus the 5, it just levels off at 150, assuming exercise and assignment went through and all these options offset each other. It just levels off at 150. None of that accounts for transaction fees or if the prices have changed, but you get the gist.
Right, and of course, a lot of these tech names now seeing, I'd say you could argue that they're on sale given the steep selling we saw into the end of the year. So perhaps a more optimistic way to look at this name, but that does it for our FOMO segment.